Describe the process of assessing individual risk. Criteria for assessing risk. Risk associated with an individual can be assessed based on the mortality rate, the morbidity rate. Criteria for assessing risk. Criteria for assessing risk. Mortality rate, morbidity rate. Mortality rate. Definition. Mortality rate refers to a fatal outcome or death. Mortality rate is the ratio of total deaths that occurred in a given group of people in a certain area over a specified defined period of time, which is usually a year. The number of deaths in a given time in a given population is the mortality or the death rate. Mortality rates are generally expressed as the number of deaths per thousand of the population per year. These rates are recorded in mortality tables which are applicable to the country in which they are to be used. Mortality table definition. Mortality table used by actuaries is a table that contains data on mortality rates on the basis of age, gender, occupation, etc. Mortality tables are also known as life tables or actuarial tables. Statistical data in a mortality table shows the probability that a certain individual will die before his next birthday on the basis of his age. Mortality rates are influenced by various factors such as nature of occupation, financial status of the individual, lifestyle and habits, history of alcohol consumption, tobacco consumption, etc. An actuary bases his assumptions on the above parameters for the different kinds of products and the demographics for which these are to be used. Morbidity rate. Definition. Morbidity rate is the frequency with which a disease appears in a group of people on the basis of their age, gender, occupation, etc. Morbidity rate is the expected number of people becoming ill or sick over a defined period, usually a year. These rates help insurers predict the likelihood that an insured will contract or develop any number of specified diseases. Morbidity rates are also used widely while designing health insurance and long term care insurance products. Morbidity risk definition. Morbidity risk arises when the probability of an individual likely to become ill or contracting an adverse medical condition is high. Example, if for a certain individual the morbidity risk is high, then the insurance company can exclude critical illness rider from the policy and grant him only the base cover with or without an appropriate loading. Assessing the individual risk. Insurance company assess the risk associated with an individual on the assumptions based on mortality and morbidity rates. Underwriters evaluate whether the risk associated with an individual can be accepted at standard rates or not, based on several factors already mentioned in above. The practices followed by underwriters must be consistent and conforming to the business guidelines laid down by the company. The decision as to whether a certain risk is standard or not is always subject to a degree of personal judgment with rationalized decisions. Hence, each of the underwriting decisions taken by an underwriter should be based with adequate rational and supporting documentation on the underwriter review sheet with regard to the final terms of acceptance, and these should not be judgmental or biased. The following decisions may be taken by an underwriter after assessing an individual's risk. Low risk cases. Underwriters generally accept most of the proposals at standard rates where the risk associated with an individual is considered to be low. However, there are also cases which cannot be accepted on these terms, example due to an adverse medical condition or for some other reason such as adverse lifestyle, occupation, etc. High risk cases. If the risk associated with the individual is considered to be high, then the risk is either accepted with some loading, exclusion, or may be declined altogether. If the risk associated with very high and an early claim is foreseen, declining the risk. If an individual is suffering from medical conditions that are so severe at the time of underwriting that risk cannot be accepted even with extra premium because an early claim is foreseen, such cases are declined. Accepting the risk with loading. If an individual is suffering from some existing medical conditions and the risk is high but can be accepted by the insurance company, then insurance cover can be provided to the individual with appropriate loading, that is with extra premium. Accepting the risk after a period of time, that is postponement. If the initial risk accepted with an individual is unacceptable at the time of underwriting but is expected to improve over a period of time, then in such cases the life insurance offer can be postponed. Insurance offer can be postponed for certain period, say between 6 months to 2 years, depending on the medical condition. After the initial high risk period has elapsed, the applicant would be evaluated and assessed afresh at that point of time. Hence, it is a win-win situation for both the individual and the insurance company. The individual can avail insurance cover over a better rate after the elapsed period of postponement, while the insurance company can deal with the reduced risk after the period of high risk has elapsed. Accepting the risk with exclusion. If a particular part of the risk associated with an individual is unacceptable to the insurance company, then exclusion may be placed on the policy. In such a scenario, the insurance company will not be liable to make any payment in the event of death from that particular risk for which the exclusion was applied. Example, in a health insurance product, if person had been diagnosed with pulmonary tuberculosis 2 years ago but was treated adequately, then insurance cover may be provided to that individual with an exclusion clause based on his medical history. In this case, if the person gets a recurrence of symptoms directly connected to TB after the policy has been issued, then the insurance company is not be liable to pay the claim as per the special exclusion accepted by the applicant at this stage of policy issuance. Exclusions are used more frequently for health insurance where the client is granted cover with exclusion due to some pre-existing impairments in lieu of totally declining the case. Decisions for substandard risk. Decision for a high risk can be declining the risk, accepting the risk with loading, accepting the risk after a period of time, accepting the risk with exclusion. Dash. Understand the classification of risk. Risk classification. Life insurance is guided on the fundamental principles of utmost good faith, that is prima facie, whereby the insurer relies on the information given by the proposer supported by necessary medical evidence wherever applicable. Based on the information collected on an individual, risk associated with an individual can be classified as standard risk and substandard risk. Risk classification, that is standard risk or substandard. Substandard can be three: increasing extra risk, decreasing extra risk, constant risk. Standard risk. Definition: if the risk associated with an individual is considered to be low or insurable at standard premium rates by insurance company, then it is known as standard risk. Substandard risk. If the risk associated with an individual is considered to be high and cannot be insured at a standard premium rates by insurance companies, then it is known as a substandard risk. The range of substandard to may also vary from being slightly by substandard to substantially substandard. If insurance companies do not differentiate between standard and substandard risks, there will be a case of adverse selection where more individuals with substandard risk will get insured, as a result of which insurance companies would have to suffer losses. Hence, the insurance company has to assess the information on individuals for risks associated with them in such a way that the mortality experiences of those who have been accepted at ordinary rates match the actuarial assumptions. The underwriter also has to ensure that the terms offered to the substandard lives are reasonable and fair, not only to the proposer but also to the other policyholders and the insurer to the extent possible. Substandard risk can be further classified as increasing extra risk, decreasing extra risk, constant extra risk. Increasing extra risk. Definition: if the risk associated with an individual is considered to be low at the time of commencement of the policy, but there is a chance of that risk becoming high after a certain period, it is known as increasing extra risk. Example: if an obese person is not suffering from any disease at the time of underwriting, then he may be considered low risk at the time of commencement of the policy. However, in the near future, with advancement of age, he is prone to certain diseases such as high blood pressure, diabetes, or heart diseases. Decreasing extra risk. Decreasing extra risk is the opposite of increasing extra risk. The risk associated with an individual is high at the time of initial underwriting but decreases over a period of time as time elapses. Definition: if the risk associated with an individual is considered to be high at the time of commencement of the policy, but there is a chance of that risk becoming low after a certain period with proper supervision and medication, it is known as decreasing extra risk. If an individual has been diagnosed with tuberculosis at the time of underwriting, then he will be categorized as high risk by underwriters. However, with the passage of time and after having undergone medical treatment and rest, he would get better. Then, as time goes by, he would become perfectly healthy again without any symptoms. Now, the risk of a recurrence becomes negligible or nil. Constant extra risk. Definition: if the risk associated with an individual is considered to remain constant over the period, then it is known as constant extra risk. In constant extra risk, the mortality risk remains the same throughout the duration of time for which the life assured is expected to do risk. Example: if an individual is a pilot, the risk associated with him will remain constant even in future as long as his occupation is a pilot, as there is always a chance of an accident. However, if this individual changes his career from a pilot to become a management executive, the risk associated with his as occupation as a pilot will cease, and then he will now be categorized as standard risk as regards his occupation. In this case, the extra premium that was charged on his early occupation can be removed. Example: if an individual has been employed as an X-ray technician for more than 15 years, then the risk associated with him will remain constant even in future, as the harmful race would have already harmed his body. In future, even if this person changes his profession to a clerk, the risk will remain the same, as his profession as an X-ray technician has caused sufficient harm to his body through radiation. Hence, extra premium will be continue to be charged. Which of the following risks associated with an individual is high at the time of initial underwriting but decreases over a period? Increasing extra risk, constant extra risk, decreasing extra risk, falling extra risk. Explain the possible outcomes of underwriting process. Possible outcomes of underwriting. An underwriter will base his decision of accepting the risk associated with an individual after careful analysis of information. If the individual is considered to carry substandard risk by an underwriter, then the decision to accept the risk can be based on following: the type of risk, increasing, decreasing, or constant, the purpose of which the insurance cover is sought, the degree or extent of severity of the risk. Postpone underwriting based on the above criteria. An underwriter can take any of the following decisions: accept the proposal with special or altered terms, postpone the proposal, decline the proposal. Underwriting decisions. Post underwriting possible decisions that can be taken by an underwriter: accept the proposal with special or altered terms, that is, charge extra premium for the extra risk, diminishing lien, specific exclusions. Postpone the proposal, decline the proposal. Accept the proposal with special or altered terms. An underwriter can decide to accept the substandard risk based on special and altered terms as follows: charge extra premium for the extra risk. In this method, an insurance company charges with extra premium cover the standard rate for accepting the risk. The decision to charge extra premium over the entire policy term or for a short term period depends upon the type of risk associated with the individual. For increasing extra risk, a level extra premium is charged by the insurance company to the policyholder for accepting the proposal. This extra premium remains the same throughout the policy term. If an increasing extra is charged for increasing risk, it would be very difficult to administer it, as it would be then necessary to monitor the health of each individual over the term of the policy. Also, if an average of the extra premium was to be made applicable to all lives, those lives with good health conditions would cease to pay the premium by walking out on the insurance cover, whereas those whose medical condition remains bad or showing a deterioration would continue forever. For constant extra risk, the level extra premium is charged by the insurance company to the policyholder for accepting the proposal. This extra premium remains the same throughout the policy term. For a decreasing extra risk, where the extra risk is of a reducing kind, it would not be fair to charge a level extra premium to this individual throughout the policy term, and the individual would be tempted to discontinue the policy. Hence, the temporary extra may be charged for a short period, predetermined period, until the time the extra risk would have either diminished or ceased to exist. Hence, such extra premium charged on a temporary basis. Diminishing lien. In this method of acceptance, the reduced basic sum assured is paid if death occurs during the lien period. In other words, a debt is created as a predetermined amount if death were to occur within a stipulated period. The amount of debt is maximum at the time of commencement of the policy, and it gradually decreases by a certain amount with each passing year, and the debt gets fully cancelled after a certain predetermined period which is specified in the schedule of the policy. However, when the debt is operative, the bonuses are paid in full under a with profit policy and not on the diminished sum assured. If death happens due to accident, no lien is applied and the claim is paid on the full base sum assured basis. This method of diminishing lien is currently not used in India, as it is felt that it defeats the very purpose of full insurance cover. If death were to occur in the first few years from commencement, while the diminishing lien clause would be ineffective. Example, if an insurance company accepts the proposal with 25% diminishing lien for 5 years, then the sum assured that is payable to the nominees in case of the insured's death will be as follows. Death in the first year from commencement, that is 75% sum assured. Death in the second year from the commencement, 80%. Death in the third year from commencement, 85%. Death in the fourth year from commencement, 90% of sum assured. Death in the fifth year from the commencement, 95% of the sum assured. From the sixth year onwards, the lien will no longer be operative, as the risk would have been diminished by then, and the full sum assured becomes payable. Specific exclusions. In this method, proposal is accepted by the insurance company with some exclusions. This clause restricts the payout of a claim for the full cover. If death were to occur under specified conditions or denies claim payment under the certain conditions. Example, policies which have a special exclusion imposed which does not pay any claim if the person dies in an air crash while he is executing his aviation duties as a fighter pilot, but would pay the claim in full if he was traveling as a regular fare paying passenger and death were to occur in an air crash. If the insured dies due to a condition that has been excluded from the policy, then the insurance company denies payment of the claim to the nominees. These exclusions could lead to litigations. Example, if policies with such exclusions are issued and assigned to mortgage loans, and if death claim is denied, this could lead to aggravated beneficiaries and legal battles between the beneficiaries and the insurance company. Example, if a certain individual is categorized as a high risk due to his hazardous occupation, then the insurance company can accept the risk with a specific exclusion. No claim will be payable if the insured dies due to occupational hazard. Postponement of the acceptance of the risk. There could be situations where the health condition of a client is uninsurable at the time of application. Example, if the client has been advised to undergo a cardiac surgery and post-operative treatment, since there exists a possibility of improvement in his health after the surgery and taking necessary rest and would treatment, it would not be fair to decline the proposal. The underwriter can take a decision to postpone the proposal for a certain period if he feels that the risk associated with the individual will diminish after a certain period and the individual can become insurable and could be accepted with a better rating. The risk cover is therefore deferred or postponed for a specific period. This benefits both the client, who gets a fair premium charged to him after the change in his health into a favorable one, and the insurer is absolved from accepting a very high risk profile at the policy commencement stage. The proposal is re-evaluated after the postponement period by the underwriter, which requires a second pre-insurance medical screening of the individual. Only after the underwriter accepts an individual to become acceptable risk after the specified period of postponement through an underwriting process once again will the proposal be accepted by the insurance company. It should be known that risk cover is not appeared automatically after the specified period of postponement. Example, if an individual has a growth or lump in the neck which is under a medical investigation, it is recommended that the acceptance of risk is postponed until it is fully medically investigated and adequately treated. The case can be reviewed only after the specified postponement period and treatment has ceased. For example, if a female applicant who is pregnant at the time of application and also has a history of two miscarriages in the past, the insurance proposal needs to be postponed till her delivery in view of the extra risk that she brings to the portfolio by way of her adverse part medical history of repeated miscarriages. Decline nature of proposal. If the risk associated with an individual is considered to be substantially high and no amount of extra premium or specified exclusions can help the company in diminishing that risk for the company, then the proposal is declined by the insurance company. Insurance companies have different threshold limits for accepting proposals. Hence, companies can have a high risk appetite, may sometimes be willing to offer insurance to a proposer who has been declined by other insurers by setting appropriate loading or altered terms. Proposals can be declined for the following medical as well as non-medical reasons, such as there is no possibility of improvement in his existing medical conditions even if the case is postponed. The country or city where the applicant lives in the restricted list of countries according to the guidelines of the insurance company. The occupation of the applicant may be extremely hazardous, making the proposal unacceptable for acceptance and the issue of policy. Test yourself. What happens to the bonus for with profit policies in case of diminishing lien? If the insured dies within the lien period, no bonus will be paid. A reduced bonus will be paid. Full bonus will be paid on the basis of sum assured. Bonus will not be paid after the lien period. Summary. Life insurance underwriting is the process of assessing, selecting, classifying, evaluating, measuring, and rating the level of risk associated with an individual, and then taking decision whether to select that risk or not. If selected, also deciding the terms of the acceptance. For performing the risk of underwriting, insurance companies here hire professionals who are referred to as underwriters. The statistical data in a mortality table shows the probability that a certain individual will die before his next birthday on the basis of his age. Morbidity risk arises when the probability that an individual becomes ill or faces an adverse medical condition is high. If the risk associated with an individual is considered to be low and insurable at standard premium rates by insurance companies, then it is known as substandard risk. If the risk associated with an individual risk is considered to be higher than the normal and cannot be insured at standard premium rates by insurance companies and is known as substandard risk. The diminishing lien method is used in cases where the risk associated with an individual is expected to diminish over a period of time. In the specific exclusions method, a proposal is accepted by the insurance company with extra exclusion clauses. The underwriter can take a decision to postpone the proposal for a certain period if he feels that the risk associated with the individual will diminish after certain period and the individual will become insurable. If the risk associated with an individual is considered to be substantially high by an underwriter and no amount of extra risk or specified exclusions and can help the company to diminishing that risk for the insurance company, then the proposal bid is declined by the insurance company.